Bitcoin has now seen a 12% correction in less than just 2 weeks. Now that may not sound like much, but this is the largest 14-day decline on Bitcoin since the tariff-driven correction in April of 2025. This move has led Bitcoin's price to break down from this rising wedge, which is seen as a bearish technical pattern, signaling deeper downside ahead. If this pattern plays out, it could take Bitcoin all the way down to $90,000 and possibly even lower. In order to truly understand what is happening on Bitcoin, we need to look at the U.S. Treasury bond market. U.S. Treasury bonds are what the entire financial system trades based on. Treasury bond yields vary based on what kind of growth and inflation investors are expecting, and the variations in Treasury yields will impact all assets in our financial system. They impact how mortgage rates are priced, how stocks and gold are priced, and they have a huge influence on Bitcoin. For example, back here in 2022, long-term bond yields were climbing as inflation fears dominated. This put downward pressure on Bitcoin's price, leading to a 70% decline. But once yields stabilized in 2023, Bitcoin finally found a bottom and began a sharp recovery. So Bitcoin had an inverse correlation with the 10-year yield during this period. However, if we fast forward to 2024, we can see that Bitcoin has actually had a positive correlation with bond yields. So in other words, investors have flown to safety whenever we've had signs of economic growth slowing down, which corresponds to when yields are falling, and they have been buying Bitcoin whenever economic growth has picked up, so periods when yields have been rising. Since May of 2025 though, yields have been gradually trending lower, while Bitcoin has continued to grind higher. This divergence sets the stage for 3 possible scenarios, each with very different implications for Bitcoin's next major move. The first scenario is that Bitcoin continues to push higher, and economic growth eventually strengthens, causing the 10-year yield to rise and catch up. The second scenario is something similar to what we saw in August of 2024. Back then, weak economic data started to show up, such as a softening labor market and rising unemployment, signaling that the economy was taking a hit from high rates. As a result, the 10-year Treasury yield fell from 4.7% to 3.6%, coinciding with a 30% drawdown on Bitcoin. The Fed responded immediately by cutting rates by 50 basis points in September, followed by 2 more 25 basis point cuts in November and December, to prevent a deeper economic slowdown. That pivot fueled a sharp Bitcoin rally into the year-end. So that's what a temporary growth scare looks like, where the Fed responds very quickly to weak economic data and the economy does not actually head into a recession. Such a scenario today would trigger some more short-term volatility on Bitcoin as yields move lower, but eventually both Bitcoin and yields would move higher as the Fed eases monetary policy. The third scenario is an outright collapse in economic growth, which would likely trigger a sharp drop in the 10-year Treasury yield and a major sell-off in Bitcoin. For example, if we rewind to the 2020 recession, we can see that bond yields went from 1.6% to 0.5% in less than 2 months. And this coincided with a 60% crash on Bitcoin as the economy entered into a contraction. Such a development today would likely bring the stock market down significantly, which is what typically happens during economic recessions. And given that Bitcoin is extremely correlated to the US stock market, this would likely drag down its performance as well.